Because if there's literally hundreds of thousands of different investment options at our fingertips, then which ones do we pick? Next up, we have commodities. So these would be raw materials that play a foundational role in global markets all over the world. So this could be anything from agricultural products to precious metals. So think gold, silver, platinum. It could be energy sources like oil, natural gas, and you could look at even agricultural staples like wheat, corn, and soybeans. And I don't want to tell you always about the winners. I'm going to tell you about a loser right now. So 25 years ago, I bought this guy's course on commodities, and then I proceeded to lose $5,000 in under a month. And that was a ton of money for me at the time. And even though I lost money on that investment, it taught me something extremely valuable, that not every shot we take goes in, that investing successfully is a process, and the important thing is to just keep shooting.
Oh, first try.
And next up, we have alternative investments. So this is a pretty big asset class. It could be what's called private equity, which is investing in private companies, typically through a fund. Or maybe you've heard the term hedge fund. And cryptocurrencies also live in this alternative investment world. So digital or virtual currencies that use the blockchain for security, like Bitcoin and Ethereum. And then we have collectibles. You'd be actually surprised, maybe even shocked at how much money you can make with art, antiques, and rare coins. These things typically appreciate in value over time, especially if you're buying right. To me, alternative investments is one of the most exciting areas that we could actually put our money into. I think Bitcoin deserves a little bit of a deeper mention here. So Bitcoin was created in 2009 and has been one of the best performing assets of the last decade. For the first decade of its life, Bitcoin was a fringe sort of niche internet thing for hackers and nerds. And I think most people just dismissed it. They looked at it as a currency for drug dealers and criminals. There's nobody in charge of Bitcoin. There's no CEO, there's no company behind it, there's really no marketing budget. That's the reason the CFTC actually classifies it as a commodity, not a security. This means anyone can now have exposure to the price appreciation of Bitcoin through a regular brokerage account by buying shares of IBIT, which is BlackRock's ETF, or FBIT, which is Fidelity's ETF. And I'm not saying that you should go out and sort of bet the farm on Bitcoin, especially if you don't have a long time horizon, because this can be very volatile in the short term. It can go up and down dramatically. But I'm telling you, if you just ignore Bitcoin, you're making a huge mistake. And then we have one of the most boring ways to invest, and that is cash as an asset class. So think a savings account, a money market fund, or CD. I don't really put much money here unless it's just parked sort of temporarily while I'm getting it ready to be deployed somewhere else. So those are the big 6 asset classes. But before you jump in, let me just simplify this a little bit more, and let's get to the exciting part. Like, how do we actually take action on all of this? Because if there's literally hundreds of thousands of different investment options at our fingertips, then which ones do we pick? There are thousands of mutual fund options out there, and each one of them has a fund manager or team. So really someone whose job it is to pick the right investments and try to grow the fund as much as possible. So that's one end of the spectrum, this world of money managers and professional stock pickers who are trying to beat the market, so to speak. And what does it mean to beat the market? Well, that would be the S&P 500. That would be the other end of the spectrum. This is going to represent the 500 largest companies publicly traded in the US. So think of companies like Google, Amazon, Walmart, Microsoft, and Tesla. This side of the spectrum is super expensive. You're going to be paying for the salaries of everyone on that investment team. And this side of the spectrum is cheap, almost no expenses. And since there's over 8,000 of these teams in the US, so then my brain asks the question, how many of these funds actually beat the market? But if we look at large cap funds over a 15-year period, or so, more than 90% underperform the S&P 500. And these are professionals getting paid millions of dollars a year to pick the right investments, and they're failing to beat the market. And this is exactly why when I talk to people important to me, people who are investing for the long term, who want a passive traditional approach, I suggest to them that they should just invest in broad market index funds like the S&P 500 or the NASDAQ 100, and then just hold on, keep your money in the market. Because not only are you likely to beat most active funds, but these index funds have significantly lower expenses and really just fewer tax implications, which to me is like a double bonus. So then I ask, could it really be that simple? And I think for most people, the answer is yes. It's a concept of a rising tide lifting all boats. And the key here is just to make sure you're in the water, that you're in the game. And for most people, just being in the market is more effective than always trying to beat it. Because of investors who spend their entire careers, have access to vast data and insights, can't consistently outperform the market over 10, 15, or 20 years, then why try to do it yourself? But before you move on, I've got two more sort of bonus ideas for you to learn about: life insurance and the Jobs Act. So certain life insurance policies like whole life or indexed universal life or variable life, they have this built-in cash value component. And that cash grows over time. And then if structured right, it can be accessed as a source of liquidity without disrupting the policy itself. The entire investment can just continue to grow even though you've taken money out of it. So in essence, we're creating this personal bank that provides stable, tax-advantaged growth and access, which we can just tap into when we need it. And to me, one of the absolute biggest advantages to this strategy is the tax benefits. The growth in my policy's cash value is tax deferred and even tax-free. So I'm not gonna be paying taxes on this each year as it grows. And then when I'm ready to access this cash, I can do so through a tax-free loan against the policy, which means I'm borrowing from my own bank without creating a taxable event. And then if something happens to me or you, the death benefit would be paid out to your beneficiaries completely tax-free. So with the right setup, we're creating this tax-advantaged investment account, this flexible source of funding that can also help protect our family while we're building wealth for the future. And I think to get the most out of this strategy, this approach, it's essential to maximize our contributions within the limits set by the IRS, because they have rules in place to prevent people from overfunding these policies just to get the tax advantages. And I think it's important to mention a few drawbacks here, that there is an insurance charge, an insurance load or expense attached to these types of investment accounts. So if you don't need life insurance, then you might want to think twice about socking a ton of money away into this type of account, unless you are perfectly healthy. You're getting the absolute best rate, because then the insurance expense or load is way less. And the other disadvantage could be if you don't have great health. If your mortality risk, like the risk of dying, is greater than average, then the insurance company could place really like a prohibitive expense on this policy that might not make the cash value build as fast as you think. It's going to be very appealing to high income earners, to business owners and entrepreneurs, and anyone who's interested in building a stable, long-term financial reserve while protecting their family. And finally, the Jobs Act, because this is one of the coolest things that President Barack Obama passed in 2012. Like, everyday people can now invest in the coffee shop down the street or a favorite startup. Because before the Jobs Act, you had to be an accredited investor, meaning you had to make a few $100,000 a year or have a net worth over $1 million to legally invest in a startup. And I know far more people who are wanting to start a coffee shop than the next big tech startup. It's probably about a 10-to-1 ratio. And the Jobs Act allowed them to raise more modest amounts, like $50,000 or a few $100,000, without needing to really attract the big boys of venture capital.